All right, guys, we're doing a reaction video today to a Morgan Stanley video. Dire warning to investors by Morgan Stanley. Now, I've not watched this video yet. I'm not a big watcher of videos. If anything, I'll listen to them in the car when driving home. I don't watch them. So we do these reactions to kind of get a feel for what's going on out there. I'm initially going to say, whatever Morgan Stanley says, I'm probably going to laugh at. And that's not to mean it's definitely going to happen. I think these banks are absolutely a joke. These banks and investment bankers and houses, they just are appealing to retail investors. They just want to churn out information as opposed to talking about long-term fundamentals. I was sick last week and I was watching CNBC. It drives me nuts watching CNBC. If you follow me on Twitter, and by the way, you can follow me below, I tweeted about this. Like literally, it makes me laugh thinking about all these CNBC experts and how they know so little about the future, about what matters in the long run. I heard a guy say, I like this company for the long term. Well, at least I'm going to hold it through the next earnings. And I'm like, the next earnings release, that's a month away. How is that the long term? So anyways, let's watch this video and let's see how long I get through it before I start to throw things across the room. So we're going to press play right now.
But we begin, as always, with three things investors ought to be thinking about right now. Stocks tumbled after hotter than expected inflation data and a dire warning from Morgan Stanley. Existing home sales continue to fall, but new home sales are surging. With mortgage rates still near their highs, what's the outlook for housing? And if you missed out on the bond rally, now you could have a second chance to jump in. On the Barron's Roundtable, my colleagues Andrew Berry, Carlton English, and Jack Howe. So, Jack, Ben takes off a week to go skiing, leaving you to explain the worst week in the market.
The heavy lifting.
Yeah.
Yeah. Third straight week of declines for stocks. Losses were really concentrated at the beginning and end of a 4-day week. On Tuesday, the S&P fell 2%. We got economic warnings from Home Depot and Walmart. And we had a report from Morgan Stanley that said that U.S. stocks have entered the death zone.
Ooh, that doesn't sound good.
One of my least favorite zones, really. I spoke with Mike Wilson. He's Morgan Stanley's chief investment officer. And death zone is a mountaineering metaphor, right? He says, basically, stock prices look too high relative to the yields that you can get now on bonds.
So I'm going to stop right there. That's a big issue for me. So 2 years ago, I was making fun of a guy named Grant Cardone because he always says 6% is better than 0%. His reason being was saying, hey, you're getting 0% of your money in the bank. You might as well buy a real estate deal that makes you 6%. To which I said, that's fair if you think 0% is forever. Is it really something that we thought was going to last forever, these 0% interest rates? Did everybody really believe that? Now, did I think the run-up we've had in interest rates would have happened? No, I wasn't going to guess that. That wasn't my job. My job was to sit there and say, do I think this interest rate environment is forever? And when we were at 0%, I did not think that. Did I know when it was going to change? No. Did I care? No. All I knew was that people were thinking this exact way. Now, all of a sudden, they're saying, wait a second, this doesn't make any sense. I can get 5% in a 90-day treasury almost. Why would I go buy the stock? Well, did you not think that was going to happen eventually? And that's the problem we have as short-term viewers of the market. You sit there and you want one short-term metric to decide if you should own a company for a long period of time. But you know what's going to happen? The second that metric changes, you're going to change your viewpoint of the company. That's why we teach here this long-term value investing approach. When I say long-term, I don't mean the US IRS code over 1 year. I mean 10, 20, 30 years. I'm going to take the frustration out of investing. Now, the 90-day treasury is at 5%. Does that seem reasonable? Yeah. Could it go to 10%? Sure. Could it go back to 0? Sure. I have no idea where it's going to go. But my goal is to buy good companies at good prices. That is absolutely my goal. And that should be your goal. And that as you buy those good companies at good prices, if the prices fall, you're going to buy more shares. You're going to dollar cost average lower. That is the key. So when I hear them talk about, oh, this new interest rate environment, that's like me saying, well, I was cheating on my wife like crazy and it was going to work until she figured out, well, you do it enough, you're eventually going to get caught. Hello, Tiger Woods. It's no different. Eventually, 0% can't last forever. Eventually, it's got to stop. Let's continue on.
Bond yields are going to come down anytime soon. And he also thinks that earnings...
And even if bond yields do come down, that's temporary. Are you going to go pay more money for a stock today because the bond yield might go down by 0.25 for 6 months? Come on, give me a break.
still way too high. So when you put it all together, he thinks that U.S. stocks could fall as much as 25% during the first half of this year before rebounding later in the year. Ouchie. And then on Friday, we got the personal...
Fall 25% before rebounding. Guys, if you believe that this person is an investor, you're absolutely wrong. You're absolutely wrong. That's not an investor. An investor doesn't care where stocks are going to go in the short run. What they care about is what stocks can I buy at good prices? And if they fall further, I'm going to buy more. For the next minute, I'm going to explain to you our software at everythingmoney.com and how you can use it to retire with more money than you thought possible. Do you get anxious every single time the market dips? Do you feel like maybe you're behind on your savings? Is it ever a worry that you may not have enough money to retire? If you've answered yes to any of these questions, then our software is absolutely perfect for you. With these easy-to-use tools and our community with thousands of other like-minded investors in there, you can use all of this to have better peace of mind and to understand why you are making the decisions you're making, because it's more about the emotion and temperament than it is about the numbers. And these tools, especially this community, will help you realize that and make better decisions going forward. You will absolutely be able to understand financial statements and impress your friends who still waste their money buying stocks based on their emotions and other hype people out there. So for a little over $1 per day, less than a cup of coffee, eliminate that fear from your life of worrying about your future financial state and your retirement savings, and try our software risk-free for 30 days. If you don't like it, email us, money back guarantee, no questions asked. Go to everythingmoney.com, sign up now, and change your financial future starting today. Now, do I believe stocks are overpriced? Absolutely. Am I being a little cautious to wait to find lower prices? Absolutely. Because there are very few stocks selling at prices that I find that I think have a very good long-term reasonable approach. Now, my holding of stocks are very limited because I'm trying to find very large companies selling at mispricing. That doesn't happen very often. That's a very difficult thing to do because the larger and larger the company is, the more and more people who follow it, the more people who are going to buy it when it falls directly, when it falls big time. So let's keep going.
Consumption expenditures price index. That's the Fed's preferred inflation measure, higher than expected. It actually rose a little bit. So whether or not you believe that stocks are in a death zone, consumers are stuck in this sticky-flation district. That's not a sticky-flation term there, Andrew.
Oh my gosh!
It's a little scary because while
at any given
time in the market you could find a bear who can say death zone type things, Mike Wilson has been really prescient. So what does an investor do?
Well, Morgan Stanley says stick with defensive sectors.
Oh my gosh.
Healthcare and staples.
Why are you going in and out of stocks all the time? Why do you waste your time going in and out of stocks? Defensive, go cyclicals. It's so stupid. It's literally asinine. Find great companies at good prices and hold them forever. If they fall further, you buy more shares. Or do this. Just buy the S&P over long periods of time. Look at this, guys. This goes back to 1993. If you just kept buying all along the way, you'd have been happy buying. You'd have been very happy buying here. You'd been very happy buying here. You'd been very happy buying here. Guess what? These are the times everybody said the world was going to end. That's what it takes for prices to fall. The story has to be the worst. Instead of worrying about jumping in and out of cyclicals, in and out of this, in and out of that, you're going to spend more money paying more taxes in the long run, as opposed to following a plan that works. Dollar cost average into low cost ETFs. And when you want to buy 10 or 20 individual stocks, you use the market going down as an opportunity to buy more of them, because in the short run, there will be mispricings. In the short run, stocks are a voting machine. In the long run, they're a weighing machine. Let's see how much longer of this I can put up with.
The firm actually has a fresh money buy list. It's kind of on the short side, but some of the names included are Coca-Cola and Verizon. I also spoke this past week with...
So Coca-Cola, which I think is massively overpriced, and Verizon, which is laden in debt. Sounds like two Buffett companies. Verizon used to be owned by Buffett last year, and now Coca-Cola. Look at Coca-Cola. This is why I laugh at this. 27 times earnings, 30 times 5-year PE. Now, they have a high return on invested capital. That's wonderful. But at some point, you got to sit there and say, what am I really getting at 30 times revenue profit? Look at this. Dividends paid. They have a high return on invested capital, but look at this. They pay out 80%. No, more than that. 85% of their free cash flow is paid out in dividends. Clearly, they can't reinvest at higher rates of return, so they have to give it back to investors. And this 2.9% yield, paying out 85% of their free cash flow in dividends, that's not very good. Guys, and should they be buying? I don't think they should be buying back shares. They're too expensive. Let's see if they're buying back shares right now. Let's go to our 8 pillars. They bought back only 1.5% of their shares. So they're being smart in the last 5 years. That means they know that their stock is overpriced, not going to buy back shares. And you better believe if their stock fell in half, Warren Buffett would be on the phone saying, buy those shares back. That would absolutely be the right thing to do. But to suggest it to be in Coca-Cola now, maybe because it'll fall less, that's just asinine. To me, 90-day treasuries at 4.8, 4.9%. Stick your money in there if you don't have anything to buy. If you've already maxed out your low-cost ETFs, and the stocks you want to own aren't selling at the right prices, you're going to get 5% sitting in the US 90-day treasuries. Why is that awesome? Why is that bad? That's awesome. Do that. Do not listen to CNBC or any of the idiots on there. Do not listen to major bankers. They're all idiots. They're absolutely idiots. To be a successful investor, you have to be an independent thinker. That is absolutely a fact. So guys, if this makes sense to you, do me one favor, subscribe to the channel. We do a lot of these reaction videos, and I just teach you how to be a little bit different. It takes time, but it's a lot of fun along the way. Thanks very much.